Good morning, Monday, March 30th, and this is going to be our weekly wrap-up show on the macro S&P levels. We're going to take a macro view all the way down to a micro view. We're going to look at the S&P, and then we're going to look at the companies that make up the S&P. We're going to look at technicals, we're going to look at fundamentals, and then I'm going to give you my best feeling based on 20 years of experience in these markets. If this interests you, stay tuned because I'm going to get into it right now. Let's first go back to the S&P 500. And let me first say that I love these macro shows. This is what I'm made of. This is what I'm built from. However, I know that these shows are not going to get the most views. I don't do this for views. I do this for you, the person listening right here and saying, I might get value from this. I better listen intently and then maybe share it with my friends. I know most people are going to want pump shows, and that's okay too. I'm going to be there for that. But at the core, I really want to help people. And even if these shows don't get the most views or don't get the most clicks, I'm still going to do them and I'm still going to be passionate about them because this is my background. This is where I come from. And this is where my value can be unlocked. So we're going to get into the S&P right now. Please like, subscribe, and comment in the bottom if you wish, and share this with your friends if it adds value. The S&P 500 is below the 200-day moving average, as I talked about in my previous shows that I'm going to link at the end here. What's very interesting to me is that the S&P 500 is 500 companies, but the top 7 companies, the Magnificent 7, make up 33% of the entire 500 companies of the S&P. That's astronomical. And the reason why I tell you this is because I'm going to go over the charts of these 7 companies. Well, maybe 5. We don't need all 7. They're all going to look the same. But I'm going to give you what I think is going to happen. But first, let's look at Twitter, Crypto X. Let's look at X, Twitter, and see what most people are saying. Most people on my timeline, and I cover a lot of people that cover technical analysis. I can't find too many people doing fundamental analysis, but I cover a lot of people, and this is the primary response. This is the most prevalent response. This is the official roadmap. Stage 1, correction. Stage 2, blow off top. Stage 3, worst crash in market history. I say this because most people believe that this pullback right here that we're experiencing right now is going to lead to a significant pump, okay? And they back that based only on technicals. Let me say that again. They back that based only on technicals, and that right there is their weakness. You have to use fundamentals. Why? Because the smart money is going to be using fundamentals. The smart money is selling at the tops like this. If you go down the list of the S&P 500 companies, you're going to see all red at the top. At the executive level, they're all selling. Why are they all selling? Because their PEs are too high. When will they buy? Probably when their PEs come to a normalized or undervalued level. I mean, that's what you do. You buy low, undervalued, and you sell overvalued. So I wanted to point this out and say, this is the majority. This is the herd, that there's going to be a dip and then we're going to rip. This guy was very interesting to me, and he does exactly what I do. Compares the 2008 GFC, the 2025 tariff, and the 2026 right now dump. And he could stick in there 2022 because that was a recession. We get a dump like we get a bounce, but he's also saying another 30% drop, another 53% drop. I believe in my heart and in using technicals that we're going to get a bounce, probably because of the end of the war. I don't know. I can only speculate. And then we're going to get more of a sell-off because the PEs are historically way too high. If you look at 2007, you can see that 2026 PEs are 50% higher than 2007. And 2007, the Dow Jones collapsed 56%. It collapsed on itself. These PEs went to 9x, way below the 12 to 15x historical average. And that was a generational buy. So these 7 companies make up, that's wrong. Make up 33% of the entire market cap of S&P companies. Correlations will be high, both up and down. When these companies go up, the S&P will go up. When these companies go down, the S&P will go down. And where is there more room to move? I ask you, do we go for higher PEs? I mean, The 100-year average is 12 to 15. We are 50%, greater than 50%, 100%. If it's 15, that's 30. We are 100% higher than the historical average. That is the question I leave to you guys. I think we have way more risk to the downside than we have expectation to the upside. Let's look at the individual companies. There's the S&P again. I think we test back up. I think it goes something like this. If I get out my drawing tools here, it goes something like this. It fights there, and then it comes way back down. And people are going to be in a rush to call the bottoms all the way down. Where is the bottom? I do not know. 2022 highs look great as a support for lows. That would be at around 5,000. And that would bring PEs way back in to normal historical averages. Amazon, it's at the beginning phase, right? So there's my PE normalization graph, right? So I'm expecting a little bit of a bounce and then a rollover. Meta already in that process. Look at that. It came up and tested already, and it's now going back down. These are things that people won't show you on X. They won't put the PEs with the technicals to say, this is where I think it's going to go based on the fundamentals. And why are fundamentals so important? Because fundamentals are earnings. PE is literally price, current price to its earnings. And what if they start guiding down? What I mean is, what if the earnings start coming in lower growth? Well, that's when the fun stuff begins. And when I say fun stuff, I mean aggressively down. Because as we see, it stairs up, elevator down, okay? This is not a forecast. This is not financial advice. I'm just presenting my ideas based on 20 years experience for entertainment and education only. Now, Microsoft, same scenario. Look, this can turn into a really nice head and shoulders, right? Look at that. Shoulder, head, shoulder, and then into 2027 down. Google's looking good actually. But, from high to low here, that's like 275 minus 3, that's like 30%, right? So it could bounce and then come below that. So on a bounce here, I'd actually be looking to short Google because I'm expecting it to get below that 200 moving average on the daily. Palantir, same stuff, right? Using the 200 daily as resistance. Really interesting stuff to me. So that's what I wanted to cover in this short, but hopefully valuable episode today. I'll recap here. These 7 companies make up 33% of the entire market cap of the 500 companies in the S&P. Correlations will be high up and down. Look at this. I mean, to me, this is just math, ladies and gentlemen. It is something to be really aware of. Yes, we could go to 40, but what is the probability, given the smart money, given people in the know, given people like me that are watching this stuff at Goldman Sachs, at SAC Capital, at the hedge funds, the buy side, Fidelity, the sell side, Morgan Stanley. They know and see what I see, and they're going to be positioned accordingly. So that's going to be the show. Like, subscribe, comment, give me your thoughts, share this on X with people that you think will possibly get value. And I'm going to be covering this on a minute-by-minute basis, and I'm going to produce something every week that shows the developments of where we are at from a comment